Thank you for being on. That's when it's your turn.
Okay.
Tesla has got some bad credit. Well, at least according to the rating agencies, despite having a ton of cash on hand, very low debt, and, very little going on that would make them not happy. Good cash flow, all that. What in the heck is going on? I'm Brian. Welcome to My Tesla Weekend. Today we've got a very special guest. Alexandra is here. You may know her as Tesla Boomer Mama on YouTube or Tesla Boomer Mama on Twitter at MME Alexandra S. Alexandra, thanks for being here.
Thank you, Brian. Thanks for having me.
You are welcome. I'm so glad I was able to make this work. We've been trying to get this for a couple weeks.
As I said, we were friends in 10 minutes. Yeah. Like which speaker, which camera, whichever.
Yeah. I had some technical difficulties getting started, and I apologize for the delay, my friends. So, tell me a little bit about your background in finance and all that.
Sure. So with my high age of 56 come, I don't know actually, how much is it now? 35 years of professional experience. So I studied in London and in Germany, and we had 2 internships, and one of them I did at Deutsche Bank. That's how I got initially into banking. Then I started with them after my studies, was a fund manager for Deutsche Bank in Paris, then moved to Commerzbank in Paris, always managing lots of, institutional money, pension funds, but also retail funds. And some of those got rated by Moody's. And so when a rating agency rates funds, they come and they meet once a year, and it's all very cozy and important. And so that's how we got to know each other. They were quite impressed, and they hired me. They hired me to look after all fund ratings in Europe. That was 1997. Sounds like a long time ago, right? And then I worked for them for 7 years. That was I'm very successful, and I learned a lot, but I have to say it was a sporty period. Left in 2003 in quite dubious circumstances. Maybe one day we'll have to talk about those as well. And created my own rating agency, set up a rating agency that's called Scope, that still exists. I sold my shares 4 years later in 2007 and left the financial markets. And then I became actually a realtor. I had my own real estate agency in the south of France for, how long was that? 7 years. And then in 2014, we moved to Santa Barbara in California. And since then I'm looking after immigrant investors, people that invest here, maybe in a little bakery or in the medium-sized companies. I help them obtain their visas, their green cards if they want that. That's my job. I'm not an immigration lawyer, but I work a lot with immigration lawyers doing the business side of things.
So what we're seeing is that Tesla's credit rating is junk, and it's not considered investment grade. What is investment grade?
So investment grade is the 4 highest notches of their letter combinations, giving a certain opinion about the credit worthiness of a company. Now you have to know that actually these ratings are not at all linked to stock. They are linked to bonds. When a company has debt, usually it's they issue bonds, and depending on how senior, how high in the hierarchy they are, if ever the company would go bust, whether they would be first served or second served or whatever, each tranche of this company that has a certain rating. How high is the probability on a span of either 12 months or a couple of years, there's short-term and long-term ratings, that this debt is going to be reimbursed. So ratings are always linked to debt and the credit worthiness. It's a little bit like the credit scores for retail, for normal people, when you have your credit score linked to your mortgage or to your credit cards. So it's the same principle, but put on the companies.
So historically, when would a company get upgraded to investment grade?
That's a good question. Well, there are a couple of different factors to be taken into account. The ratings are different compared to industry sectors. Typically, rating agencies, analysts, I hope some of them listen to me, because they'll straight away know of whom I'm talking are quite boring people. They are rather the value investors themselves, right? So they would favor or consider more stable the typical value sectors of our industries. So it is obviously easier for a company that has been established for a long time and has never had to go into bankruptcy to convince them that they are worthy of investment grade. So time is a factor, stability of the industry sector is one. Also, obviously, key personnel, barriers to entry. So there are a couple of things that come to it. So there is not a typical moment where you can say, well, a company has to be 2 years old to be considered getting into investment grade. It's a matter of quite a lot of different factors, but it always comes down at the very last moment to the question is the debt creditworthy? That's the main thing they have to express. That's why investors are actually looking to them. And let me just tell you a little story. This all started with John Moody 100 and something years ago, who left New York. He was working at Wall Street then and traveled to see all the railroad building sites. So he spoke to the foreman there. He learned about each little, well, where they were building, and he rated them. And then he went back to Wall Street and said, well, if you want to do the tranche going through Kansas, that looked like really a great team. Give them money, and they only have to pay back a certain interest rate, not a high spread, because they look very serious, and other people look less serious. And that's how it all started. And then he nearly went bankrupt in the 1920s, and S&P purchased the AAA labels from Moody so that he could survive. And then he started with these letter combinations with capital and non-capital combinations, which is just, I mean, shows you what jerks they all are. And so since then, this has survived. Now, ratings have not always been very popular, but in that period, there was just no information flow, right? Up to the 70s and 80s, you really had problems getting information about these companies. So they were typically linked. Moody's was very closely linked to Dun & Bradstreet, or was it S&P? Well, one of them. So they were linked to publishing houses who were collecting all these company data, and then they made the ratings out of it. It was the sheer lack of information. Now, obviously, there are 2 or 3 things that happened since. We had the financial crisis where they were completely ridiculous, right? Because they had lots of ratings still in investment grade that went bust. And then the other thing is we now have an overflow of information. Anybody can do, as I show actually, anybody can do ratings quite quickly, quite intelligently, and be much more precise than they are. Okay, so they are still clinging to a certain power, because up to now, and that changed just now as we're speaking, up to now there were obligations for pension funds and for certain institutional funds to have only stock with investment grade, which, like I said, is a strange combination, because investment grade applies to bonds, it doesn't apply to stocks, but there we go. Just because that was considered secure, and the SEC had actually these rules in place, right? They're currently abolishing these, but there are still lots of people around, especially the more, old style fund managers. Also, lots of financial advisors have in their mandates that they can only use the money of their clients for investment grade investments, right? So there's lots of stuff still linked to it, yet it's not deserved anymore.
So on the list, you published this really cool list. Maybe that's what you're going to share next. Is there's a bunch of companies that on the surface do not look as sound and stable as Tesla.
Oh, they
have
don't.
a much higher rating. Yeah. Can you give us some examples of those?
Yeah, let me show you. So this is the one that I did in April with Q1 data. Tomorrow evening, I'm gonna publish the, let me see if I can get that a bit bigger. Yeah, can you see that? Is that?
Yeah, only kinda, because it's, when you went full screen, it busted out of my because I'm not using a full screen, I'm using just a portion of a screen.
Let me see whether, if I do it a second time, let me see now.
Do it like that, and then don't full screen it.
How is it now?
Same.
Well, maybe that's because it's, and now?
It's just making it smaller.
Okay. Well, let me read off it anyway. I'll show you quickly.
Make it a little bit smaller, and I will recenter my box here. There you go. Do that. Okay.
Tell me.
Now go.
Okay. So this is the list I published in beginning of May, I think it was, with Q1 data. I always have to wait for them all to have published their quarterly data, and then it has to go through the SEC publications and the software I use, which is Guru Focus, brings it up, and then I can do this easily. I mean, otherwise it would really be days of work, but it's actually not that much of a work when you use a tool like Guru Focus, and there are quite a lot of tools like that out there. So what did I do? I used the top 30 market caps. I actually eliminated 2. There was a Chinese company for which there was neither ratings nor lots of information, so I eliminated that. And there was a Saudi Arabian Aramco that I didn't have data either, so I took those 2 out. So you have the top 28, with 2 missing would have made 30, by market cap. So the obviously biggest market cap is Apple, then comes Microsoft, Alphabet, Amazon, 5th was Tesla. So this was all done on the 17th of May 2022. And for most of them, I then had the Q1 data, except for a couple of them where you see the asterisks where I didn't have them yet. And then I added nearly 10 car makers, which are smaller in market cap, but which I thought was also an interesting comparison, obviously, to Tesla. What did I do for them? For all of them, I listed them by market cap. I listed their cash flow. And I mean, obviously, Tesla is not the biggest cash flow producer. That is still by far Apple, Microsoft, and Alphabet, but it is not ridiculously small either. And then I used 5 of the calculations that we used for ratings. Okay, so it's cash to debt, it's debt to equity, and I can explain those if that's of interest. Debt to EBITDA, debt to revenue, but you see, it's always debt. Again, coming back to this creditworthiness of their bonds, and then the Altman Z-score. And then in the last 2 columns, I have the ratings from Moody's. And if they are green, they're investment grade. And if they are not green, they're orange, they're junk rated. I also, for all 5 columns, used the same color code, meaning when they were in the good fields, they were getting greener and greener, the darker the better. And when they were getting into the critical or in the lower results, they would be orange, either light orange, or if it's really bad, dark orange. And so what was really surprising is that all except for Tesla of the top 28 were rated investment grade, yet not all were in the green for certain ratios. But was even more surprising for the car makers, other than Honda for one argument, all were in the bad field, yet other than Ford, everybody had investment grade.
Which is frankly a bit crazy.
It's absolutely ridiculous. Now, there are a couple of reasons for that. There is obviously long-standing relationships between these car makers and other companies and rating agencies. They issue a lot of debt, which Tesla does not. Tesla does not need to issue debt. So they're not at all dependent, because how are rating agencies paid? Rating agencies are paid by the quantity of the issued debt. So it's not just that they do once a year a rating. If then any of the debt that is issued uses that rating, the issuer has to pay again, a percentage of the amount. So more money the car makers need, and currently they need a lot of money, more money the rating agency gets. And also more money, no, sorry, let me take it the other way. If the car maker has still investment grade, easier it's going to be for them to get financing, to find purchasers of their bonds, right? So there is a real interest of everybody to keep them at a investment grade level, so that they can get relatively reasonable financing. It costs them much less to, how shall I put this politically correct, to work in good cooperation with the rating agencies to maintain their investment grade than it would cost them to finance with a junk rating.
Wow. Are there any companies you know of that have a better cash flow, cash balance, and debt load that are not investment grade?
I mean, Alphabet, I mean, it's completely ridiculous. And that's why I think actually this table is so, even if people don't really understand how to calculate these different numbers, it shows very clearly how unfair the whole situation is. Tesla is at the level of Alphabet, Google, right? It is a little bit less good, but it's still second position, I think third position for cash to debt. But it has the highest Altman Z-score. Now, let's probably get to the Altman Z-score here, because for me, that is the best measure whatsoever.
Do we need the chart up still, or should we close that?
Oh, no, we don't. We can close that. Let me just put it away so I can see my sheet and I'm not forgetting anything, because this is, I mean, Altman Z is really, is really complicated. To make it easy, Altman Z is really the best measure to predict whether a company is going to go bust in the next 2 years.
Wow.
So if you are worried, if you're investing with a big spread in the bond market or in stock that may become real junk, one thing you should look after is Altman Z. Oh, and that's actually a good thing I want to show you. I published something yesterday. If you don't mind, I share one more. Let me see whether I can still find that, because I had it yesterday. Here it is. Actually, here it is. I think this one is a very good example, and let's hope that you tell me how the resolution is.
Make it smaller?
Make it smaller. Can I make it smaller? Let me see whether I can make it smaller like this. Better?
Hey. Yep, fits.
Okay, good. Okay, so this is actually a very good example. Let's go away from Tesla for a moment about Altman Z. Altman Z, the only thing you have to keep in mind at the moment, I'll explain later how it's calculated, is if Altman Z is 3, the number 3 or higher, there's virtually no risk that this company is going to go bankrupt in the next 2 years. Okay. If it gets between 3 and 1.1, lower it goes, more risky it becomes. But up to 1.1 is what is considered the gray zone. That's how he was a professor of finance at New York University, NYU, and that's how he described it. Lower than 1.1 is the red zone, right? That's where you really should get a lot of premium for investing into junk. So you have here the lines of Bear Stearns, AIG, Lehman Brothers, Washington Mutual, Ford Motors, and MF Global. All of these went bust at different dates between 2007 and 2011. Then in this, and I found this on Wikipedia, here is the Altman Z-score 4 years prior, 3 years prior, 2 years prior, 1 year prior, and in the year of default. And so you see none of them is above 1.3. I think here is one at 1.32 for Ford, but all of them were low. Yet the first 4 at the moment of the default were still rated investment grade.
Wow.
I mean, this is absolutely ignorant, right? They had 4 years of the best signal ever, because this signal existed at that moment for at least 20 years already. Everybody used it. Yet they didn't see it coming, not at all, and didn't move. And I think this is a very, very good example of relationship between corporations and rating agencies. They're in the same boat. They have the same interest. These companies needed to finance, needed to find buyers of their debt. Yet the investment grade was really important, and yet nobody woke up. Wow. Okay, so that's how it works. So, I mean, I don't know how detailed your audience wants to know what is all about, but Altman Z was really clever in putting together quite a lot of different market indicators, earnings, asset, liabilities, and market value and all that, and gave it certain coefficients so everybody can recalculate it. But the good thing about today is that, Yahoo Finance and any public site actually calculates it for you all the time. So the only thing you have to know is 3 and above is good. 1.1 to 3 is gray zone. Below 1.1, don't touch, okay? Tesla in Q1 had 16. Okay, now here I want to show you something else, and I don't know whether this is going to be easy to show, but I will try, because it's really It's one of my preferred ones. Is it this one? Just give me a second.
So there were a couple questions that came in while we were talking.
Sure.
JJ wanted to know, is it because Tesla only started to be green recently?
No, this is overdue now. I mean, this has been overdue since 2022 started. After the Q4 results, which were excellent, we'll remember, that would have been the moment they should have really started at least giving them low investment grade. For me today, Tesla is worth AA. Okay, maybe not AAA. I can, find a reasoning for that, but we're 4 notches lower. This is crazy. This is absolutely crazy. So let me just try to share this one, and you tell me whether you can see this. So this is this tool I use called Guru Focus, and this is the Tesla Altman Z-score and the distribution among 1,200 car vehicles and car parts corporations.
Okay.
So you have Altman Z below 1.1, only a couple, 6%. But then you have a lot of them in the range between 1.1 and 3. Can you see it, Brian?
Yes.
Is it?
Yes.
Okay, good. And then obviously after you got to the 3 points, so now you have 72% of the industry is in this gray zone, right? And then you have the rest of the industry in the higher zone, and Tesla is the red one here, okay? So Tesla has the highest Altman Z-score in the whole industry, not only among the 10 car makers I'm comparing. Of all 1,130 car and car parts and whatever, anything to do in that industry, there they are, right? That is it. They're in the 0.12% of the highest.
Wow. Wow.
Yeah.
So that raises the question. Let's go ahead and exit out of that. The question, what on earth is going on?
That's the best question, and I wish I would know, and that's why I'm so nagging with them, right? I mean, you see probably my daily tweets. I mean, it's not I'm a little bit of a nagging person if I want to, but it's not my joy in being known for nagging rating agencies, right? I'd rather be known for being a nice mama, but they really need to be called out, and nobody really calls them out, right? And so the way this whole situation is set up is Tesla is obviously not a client of them. Tesla doesn't need the rating. Tesla doesn't have debt outstanding that is rated. If Tesla ever would have to have some tranches of, they still have some old convertible stuff. That's why there's still a rating around. But they could actually just say, look, we don't want to have any outstanding debt anymore, and then you can't rate anything, and then we're not junk anymore, right? But
Right.
Obviously Elon and the team also knows that it gives them access to portfolio managers' money that only want investment grade, so they're sitting it out to become investment grade just for the sake of being investment grade, right? So this is a stupid chicken and egg problem. They don't need the debt, so they don't pay the rating agencies, and obviously don't play at all any of these corporate friendly games of, I give you money, you give me money, you give me a nice rating, I get a little bit of debt out of it, whatever. It's just nothing. Tesla doesn't do it. And so the rating agencies have motivation is the wrong word, because if they would have ethics, they would have a motivation, right? But they don't have any financial motivation. They don't have somebody sitting in their rating sales department saying, oh, look, they just signed a big contract. You have to know that these companies typically have contracts between 300,000 and 2 million per year with the rating agencies. These rating agencies have, I think Moody's is 6 billion of assets, and S&P is 8 billion. These are huge firms, and please consider all they sell is hot air, 3 letters, right? There's nothing else. These 3-letter combinations still have a value because people with high ratings can finance cheaper, but it's only hot air. There's nothing behind it. You have behind every rating a page of disclaimer where they say, we don't know anything, we didn't do any due diligence, this is just an opinion, you can't sue us, we never pretended we know anything. So they're probably spending more money on lawyers writing their disclaimers than on anything else. but the money coming in is enormous. They get money from the issuer, they get money from the asset managers that use the ratings, they get money from the benchmark that are indexed on the ratings, so that they know how to make money on it, but yet it is only letters, right? There's no good, there's nothing you can touch, there's nothing tangible, nothing.
So what would happen, do you think, to the price of Tesla stock if it was upgraded to investment grade?
I think it has a big push to purchase. So I do believe it will go up. But is it like an inclusion in an index? Not at all. So it's not at a defined date. And let me maybe first explain when will they update, right? I was hoping they update in August, because August is one of those lame duck moments in the financial markets. Lots of people are on vacation, not much real big news. The Fed is not meeting. So it's a typical month where if you want to upgrade somebody and just want to be forgotten, that's the moment you would do it. That was my thinking. Obviously, they haven't done it yet, but I'm still hoping. And so what would happen, what would need to happen for them to upgrade? Both at S&P and at Moody's, because they work obviously separately, but they do everything in common, right? You will see that if you look at those ratings, they're nearly always the same. The analyst in charge of Tesla has to call in for a rating committee with his superior, and usually there's somebody else from the senior management of Moody's, special or S&P, especially for a sensitive case like that one that assists. There may also be other car analysts in that same meeting. The lead analyst brings forward his cause, say, look, this is overdue, we need to upgrade them. And then there is a vote. If the vote is a tie, the most senior person in the room cuts the tie. And then if that is an upgrade, well, the analyst goes out of the meeting, writes the press release, and within 24 hours it's out and everybody knows about it. So it can happen any day. It can happen on Saturday, it can happen in August, it can happen in December. There is nothing to it. So once it happens, it's not going to be as if now these pension funds and these investment funds and these financial advisors from one day to the next, like with an index, all have to start buying. Okay, it's nothing imminent, but I do believe that the constant flow will just be much stronger. The current retail investor doesn't want to sell. I mean, there's so many more Tesla investors who want to hold forever, at least until 2030, and probably then until 2040, and probably then until 2050. But so that just the pure pressure will bring the stock higher, but it's not going to be as imminent as it was in that 3-week period where we had inclusion in the S&P 500 index, because that was really a moment on that certain date. Now 2% of that index money had from all different index funds be allocated to Tesla. So that was really one precise moment in time. Here it will be much more spread over time.
So in your opinion, what should the rating be today?
Well, like I said, I think I could live with a AA because that's what they deserve. I can hear arguments, they haven't been there long enough, and it's still, cash from operations is still only 14 billion. I mean, I can hear it. I don't believe it, but I can hear arguments for not doing a AAA, okay? But the thing is, that's not how it works. When you have currently a speculative rating, it will be upgraded one notch. It will go from BA to BAA, right? So it will not go in the AA range yet, but that doesn't matter. It is the door that it's opening to investment grade that's important. It's ridiculous because it would deserve much better, but that would mean they would publicly admit that they were wrong, and they're never going to do that. So they're going to just upgrade by one notch. Tesla is currently at the very highest junk rating. So the slightest little upgrade brings them straight away into the investment.
So it goes AAA, AA, A,
yeah,
BAA, Batman symbol.
That's Moody's, exactly. That's Moody's, and at S&P it's BBB, BB, whatever. Yeah, and so the limit is between the BBs and the BBBs.
Could they not use a numeric score?
Well, could they not just close business?
No, because money.
There you go. And good money and lots of money.
A numeric score would allow every bank and every investor, everyone to have their own risk tolerance, their own cutoffs.
But what I can tell you is while 20 years ago still everybody used them, especially for credit default swaps, right? I mean, this may be not something that lots of people that listen here are aware of, but credit default swaps are really the big, very large, very liquid market where the creditworthiness of an issuer plays a role, because that's the spread that is added on when you swap whatever, a variable rate against a fixed rate, a 5-year against a 2-year, whatever, that's the spread you put on it. Nobody in that market looks at the rating agencies anymore. They laugh about the rating agencies, right? What we hope, and I'm certain about it, is this upgrade to investment grade won't have an impact really on Wall Street. They laugh about the rating agencies for a long time, but at all the other locations, meaning, you know, the pension funds of the teachers of Rhode Island and the hospital workers of Kansas and whatever, because those are people that still have quite old style rules, especially when it's linked to government, who at one point had to set up these rules and then nobody revised them. So it's not as if, and once they're there and written and the fund manager does it, it's difficult to overcome. So it's much easier to slip into investment grade than make these people change their rules.
So a question from one of the viewers, who is this, wants to know, what does it take to progress up through those last 4 rungs? Is it just time?
Well, the time is certainly a factor. Like they won't upgrade quickly. You know, this is nothing, because that would be admitting they were wrong. So time is a big one. And obviously the problem for Tesla, which is a stupid problem, is with a high level, they currently give them junk. So they must have an even higher level to now progress the 4 steps. You understand what I mean? Which they will. We all know they will, but it's completely ridiculous, because they will be the strongest single A that has ever been there. They will be the strongest double A that has ever been there, until they will finally be triple A.
Wow. So getting off of the S&P and Moody's ratings, and by the way, Alexandra tweets this stuff every day, and you are free to quote tweet it at Moody's and S&P, which some of us do. More attention is better.
Thank you.
And I'll put a link to that. Oh, I've already got a link to your Twitter, I think. Maybe, whatever. We'll get that sorted out. Another one that you talk about on your channel is the ESG rating, which somehow Tesla didn't get. So tell us what.
Well, actually, they got it. They got it, and they were thrown out in May.
Oh,
so how did that come along?
So first, tell us what the ESG rating is, and then tell us what happened.
Okay. So in the early 2000s, somebody, I can still not put my finger exactly on whom, had this glorious idea to come up with ESG scores. So E is for environmental, S is for social, and G is for governance. So the aim was to score companies' behavior. Are they having a good impact on the environment? Are they socially accepting any whatever people, whatever workplace, whatever? And governance, do they have the right governance method implemented in their systems? So and how these 3 got commingled, that's still my big miracle. And so over about 10 years, this was lingering around, and some social justice warriors used it, and some the first environmental funds used it, but it wasn't really that hot. And then in 2015-16, Paris Accords and the Europeans had some measures, and here Bloomberg had some measures. So lots of people started working on different corners of that. And today we've come together. It's become really institutionalized. And the COP26 last year in November, President of the United States, Biden, those 26 nations decided that they want a common standard for that, and the common standard then has to be adopted by all companies publishing financial results. They will then have to put this ESG information in there. So lots of people were happy, not people we know, but accountants, rating agencies, and people that work in that field, because this was now institutionalizing their work. right? So we were going from 15 years ago, some social warriors that probably the last thing they wanted was, that accountants now suddenly looked after the subject, to now, the gray mice of our industries being very happy that they had more number crunching to do and more comparable data to deliver, because that's where we're getting to. This is all a data-driven thing now. We're not at all anymore in any being good. We're in who prepares the data so that it looks good scheme. So there are lots of players. This is a huge gravy train. There are a lot of people interested of making this institutionalized, so that meaning, the SEC is there, the different accounting firms, especially the big four, all push for this to become norms and oblige companies to obey to these. Okay, so this obviously didn't go down nicely with Elon, you can imagine. So that's the first one. Then the second thing happened at the same time is S&P and Moody's purchased different little boutiques who were specialized in this data collection, and S&P mirrored the S&P 500 with an S&P 500 ESG index, meaning they used the normal S&P 500, where it's just going by market cap, and said to all these 500 companies, fill out a questionnaire, we will collect data, and we will rate you. And obviously at Tesla and at many others, nobody even responded, right? And that all happened when in April, I think it was, Elon started being interested in Twitter, which didn't go down nicely with a lot of the establishment. And so last year, Tesla was in this ESG index with its 2% weight that corresponded to the S&P 500 weight. And then this year in May, from one day to the next, S&P announced that Tesla was thrown out and replaced by number 501 to go in there. Why? Because they had some social issues with people suing them over workplace discrimination. They didn't answer the questionnaire. They didn't do this. They didn't do that. And they had decided in the rating committee that they were just not looking well after all the societal benefits, and off it was. So, ESG, for most people, think this is just an environmental thing. This is a political game putting pressure on companies to deliver data, meaning paying, okay? Because they all collect for free data, but then if you want to know what happens to your data, you obviously have to purchase consulting services and all that. And then you will be taught how to game the system, because they give you the rules of the system, so then you can game them, so then you get better scores, so that you then get a better rating, and then you get better financing, and then you're in the hole. And everybody's happy because everybody got paid.
So ridiculous.
It is completely ridiculous.
Are there any other lists that Tesla's been left off of?
No, and I mean, there are some that are treating Tesla a bit better than others. MSCI is doing an ESG rating. They haven't thrown Tesla off yet. But there's nobody helping Tesla. Let's put it this way. There are people that are more neutral than S&P and Moody, who are really nasty, because they feel they still have a little bit of power, which they do. And others are more neutral because they just think, well, we may actually lose a part of our clients or fund managers that will be stressed by their clients if we go too badly against Tesla. I mean, Tesla is such a divisive subject, right? It's a little bit like politics. Either you love it, or I can't understand, or you hate it, right? And so some people are clever enough just to stay out of the game. But S&P in particular is very much in the game.
So we did a poll here. I did a poll asking, when will they get their upgrade? 17% said this month or next. 43% said Q4. 25% said 2023. And 15% said never.
Ooh, 15%. Well, I mean, I don't think never, because what we need to get is public attention. We already had an article in Barron's, and the subject comes up now because it's really ridiculous. It's so evident it's ridiculous. And I've nearly finished my Q2 table. It's getting even more ridiculous. Okay, so I can assure everybody tomorrow is going to be even more funny. But the thing is, how much longer can they play blind? And that really depends how much attention we can get on the matter.
Yeah, the thing that surprised me with the very late S&P inclusion is it's your own credibility that's on the line at that point, because it was evident that, and we can't include them because unless we make an exception, we have to have the consecutive. It's like, well, right, but you do make exceptions. You have made them in the past. The trajectory is crystal clear, and a lot of folks who had index funds lost out on the 20x run up, which is.
Well, that brings me to a subject that I'm very passionate about. I mean, I'm passionate about quite a lot of things, but one thing is I hate, and I mean hate. I mean, I hate rating agencies, but I really hate index funds. I cannot understand all these people, going, oh, I'm going to a QQQ ETF and whatever. You're giving away so much when you're going into an index fund. First of all, why is this index how it is? It's because it's the market capitalization of the past. So you're especially Tesla investors who reason everything in the future, who know exactly how much they will produce in 2 years and in 5 years and what the bot will come in. I mean, we take it from all sides. And then you'd go in a fund that is looking at market caps from the last 12 months, trailing 12 months. This is ridiculous. The second thing is the index itself, as we have experienced when Tesla was included in the S&P 500, is manipulated by these index makers, right? Be it S&P, be it Dow Jones, be it whatever, whoever it is. So you actually depend on an index maker when they let, one of the stocks in or drops one of the stocks or whatever. There's some rules out there, but it's a little bit shenanigans, right? The third one that I really don't like is when you're giving your money to an index fund, you're also giving your proxy vote with it. So these asset managers have then suddenly, these Vanguards, the State Streets, these BlackRocks have suddenly enormous power when they vote at shareholder meetings. And all these things people don't realize when they go into an index fund.
Wow.
Sorry.
No, you're blowing my mind. Someone else in the comments already said, she's blowing my mind right now.
Oh, I'm sorry.
No, hey, it has to happen. When you got a cold, blow your nose, man. If our brains are congested, we got to sort this out.
Take an aspirin.
Yeah, if anyone's got some questions, get them in, because those were the questions I had. And let's see here. Pat says, I invest in index funds to limit risk. Tesla is about 22%, the rest in index. For this audience,
I just want people to really understand what they're doing with their index funds. I mean, first of all, you're giving away management fees. They're not high in ETFs, and that is the main attraction, but you're really giving away a lot, and your index is looking in the rear view mirror. It's together because the last 12 months, that was the weight of it, or 24 months, depends which index you take, but it's never anything forward looking.
Yeah. She knows the data of people who invest in index versus single stocks, so this is a confusing stance. Let's see, question. Is there a date or event where the credit rating agencies must upgrade or do? No.
I wish there would be. Oh my gosh. Then I wouldn't have taken all these bets for end of August. You know that if I lose, if they don't do it end of August, I have to become a super follower of Earl.
Oh, wow. Nice.
And that's Herbert who got me into that. And I'm like, oh, do I want to do that? $2.99. I'm just joking. I love Earl.
Wow. Okay. What do you recommend then? All in on Tesla?
Well, I am. This is crazy. So I was fund manager. I was brought up. I'm the pure breed of how to diversify in 20, 30, 40 stock, how to leverage all the time. It was crazy. And then, so when I discovered Tesla, it was actually in 2020, we were on the wait list for an M3, for a Model 3 in 2017, but it was just, the ramp up and we couldn't get it. We needed a car, so we took a Bolt, a lease for 3 years. And so when that came up in May 2020, middle of COVID, um, there were Teslas available. So we gave back the Bolt and got the Model 3, and we did a test drive before. I came back from that test drive, and the stock was in the 300s then, so that was pre-split. And I said to my husband, that's it. We're buying, we're selling everything, we're going all in. And he was, you're sure? I said, I'm sure. I said, I'd never heard you say that. I said, there's nothing else that will ever convince me like this. This is not a car, this is a computer. The software is going to be the main selling point. This software is going to be in all cars worldwide. This is going to be like the new Apple, but in a much bigger, phone is $1,000. This is a $50,000 purchase. So, I mean, I did a little bit of napkin up, and it was clear that I wanted to be in nothing else, right? And then I did what I always do. I said, let's sleep one night over it. Next morning, I was still as convinced. And since then, I've always been 100% in. Now, I can't give investment advice because, my situation is I still make a good chunk of money every month because my day job really pays me well. So I don't need that money. I'm not at a moment where I'm close to retirement and I need to do that. I don't need to invest in a house at the moment. So I can do that. Everybody has a very special situation. It needs children, education, retirement, whatever. So I can't speak to others, but I would have never thought I would be where I am today.
I think that's pretty exciting. And the thing is, if you believe Tesla is going to grow by, double and then double again, and then add the mega packs, even if they don't crack autonomy, those are, if you look at the world's biggest companies, more than half of them stand at risk of disruption from
Exactly.
Tesla.
Exactly. So and it's everywhere, right? So I'm really not worried. I look at the stock price every day, once in the morning, once at lunchtime, but I'm not at all worried. When it went down to 650, I bought at 650, but I'm actually buying every month with every left. I got so stingy. It's really bad. I can't believe it. I was usually a nice little spender. But those days are gone because I just want to make sure I have every month sent enough to buy more shares.
Fantastic. Well, I certainly appreciate your time. As a reminder, Tesla Boomer Mama is on YouTube with a channel of that name, and she's on Twitter at MME Alexandra.
Yeah, that's Madame, because I opened it when I was still in France. That's Madame.
Oh, okay. And on the replay, I will put all that stuff on screen, and I'll put up supporting graphics and all that. But I figured since we're both here anyway, let's do it live. And boy, was that an exciting adventure.
Thank you very much, and thank you for letting me talk, Brian. Thank you very much. I appreciate that.
Yeah, and in the comments, guys, what did we miss? What did we misunderstand? Leave us all your wisdom, your brilliance. And by the way, Simon is giving me grief. He says, greeting from Germany. He was the German Tesla thesis guy.
Oh, I know. He sent me his thesis, and really great. I mean, he got A+ obviously for it, and he did a great thesis on Tesla.
And Marcus got one in under the wire here. Today, a Mercedes executive said it's over, Tesla won. Big if true. If that happened,
Well, big if true, but I can tell you, they're actually late. They're so late.
Well, yeah, a lot of people. I've been hearing that once the big guys turn on the faucet, it's going to be over. Tesla can't compete. They can't scale.
I have a theory that I hear very little, and I would like to hear it from people because I'm not as knowledgeable as all these people are on batteries and software and whatever, but I do believe that the Tesla software is going to be in other cars, meaning, that a Toyota will have the hardware, but the software will be Tesla's inside.
Yeah. And what do you think of Tesla's competition?
Which competition?
Yeah.
I mean, there is some, and actually it's funny when I do my tables, the orange and green ones, I also look at Rivian, Lucid, and whatever, and actually they have quite good cash positions. Rivian is financially much stronger than Ford and GM. It's crazy to say so, but that's the way it is. But anyway, I mean, they're small. I think they have still a lot of challenges to overcome. Production is hard. I actually wish there are a lot of little competitors. They will never reach Tesla. They will never reach the software of Tesla. I mean, they may build cute electric trucks, like the Rivian is a cute electric truck. But can you imagine the day Cybertruck is out? That's it. Will have been 1 year of a cute truck.
And I've got a viewer named JJ who loves to give me a hard time, and just because I'm in a good mood, I'll go ahead and ask the question. He wants to know your thoughts on Nikola.
Oh, I don't have any thoughts of Nikola. The only thing I saw is how he pushed the truck downhill.
Yeah.
That's it.
Yeah.
No, I don't have any. I don't have any thoughts on
that?
Nikola.
Yeah. Yeah. All
You
right.
know, have you seen those rumors that Toyota wants to buy them? It was only rumors. I don't know whether it's going to.
I looked into that, and I could only find one source for it, and it was Seeking Alpha. So I would still classify that as a rumor. I don't know what Toyota would get out of it that they couldn't develop themselves. So I'm not sure, but it's, it's possible. I think that would be a very good move for Nikola if they were acquired. And I think the stock is low enough that they would be affordable if there's something of value that Toyota could use. All right. So, yeah, let us know in the comments. What do we miss? What do we misunderstand? Stay tuned, stay juicy, and I can't wait to hear from you. Clever robots on the flippity flop. Alexandra, thank you so much.
Thank you, Brian. It's been lovely. And thank you for making this happen despite all our